All right, we're back at it again with another episode, and this time we're talking all about stocks. So, with stocks, there's a lot of different things, a lot of different moving parts. It gets really extensive, really intricate, but we're gonna start with a preliminary definitions. You know, with the first part of our episodes, we talk about definitions, then we move into use cases. So, I have about 10 or so definitions that I want to get into today. And it first starts off with what a stock is in the first place. Everybody uses the word stock. But what does that mean? What is a stock? Like I said last time, what is a real estate? We could go check out last episode. Anyways, with stock is very simple to understand. It just represents amount of ownership that you can have in a specific company or entity. For example, let's say I bought some pizza, right? And it was cut into 8 slices. The smallest amount of pizza that you can have is 1 slice. So that's 1/8 of the total pie. Now, if you're feeling like, a little extra hungry or you're balling a little bit more, you may get more than just the smallest amount. For example, you may get 2 or 3 slices. And if you're really hungry, you may get, 4 or 5. Same thing with stocks. If you're really interested in it, you may get more than 1 share. But you may get more than 1 share because you're a little bit more hungry or you're a little bit more interested in a specific company. So when you say a stock market, what does that mean? A stock market is just a place where you could buy, sell, and trade stocks. Pretty easy to understand. Just like when you went back in the day and got your clothes from the flea market. I'm joking, but yeah, the flea market is the exact same thing. I know a lot of people have been there. You go to the flea market or the swap meet, right? You go over, you may talk to somebody and be like, hey, this is dope. I might want to, cop that off of you. Or I may want to sell you something, set up a table or a vendor booth. And you just buy, sell, trade, and you leave with more things that you're interested in and less things that you don't really need. It's the exact same thing with stocks. You're able to buy stocks, sell stocks, and trade stocks based upon your own profile, what you want, and what you're interested in. So now you know what a stock and a stock market is. Next, let's get into why this is important. This is important mainly because of one concept. And we're going to spend a little bit of time on this concept. That concept is supply and demand. Supply and demand is really what drives the pricing and how people genuinely make money and sustain wealth over time. Supply and demand is represented by 2 different entities, obviously, supply and demand. So let's define both. Supply essentially is just the amount, the quantity. That's it. If I came out with my own product, how many units do I have, right? That's a supply. Demand is how interested other people or other entities are in purchasing or receiving that product. Now that could be a little bit more ambiguous or harder to define because it's kind of not as obvious to figure out how many people want a certain thing. That's always evolving, right? The supply can be a little bit more consistent because I'm the one who gets to produce it. So when it comes to demand and supply and how they correlate, what you're gonna get out of that is the price. For example, if I have a lot of product and everybody wants one of each, the price is gonna, sustain. It's gonna be the same. For example, let's say I have 10 cameras. Each camera is accounted for because only 10 people want it. I could just say this is the price of the camera, it's $10, and it's not gonna change. Now let's say the demand changes a little bit. Let's say people want the camera a little bit more because they love the image quality. So 100 people want the camera now and there's only 10. In order to get to a point in which only 10 people are able to get it or are interested in it, what I'm going to do is raise the price. It makes it beneficial for me and it also weeds out the people who don't really want that camera. The exact same thing for the opposite. Let's say I have 10 cameras and only about 2 people want it. What I'm gonna have to do is drop the price so that I can sell the other 8 units, mainly because the supply is more than the demand. And the opposite is true. Let's say the demand is consistent and the supply is starting to fluctuate. If the supply drops down and the demand is consistent, I still gotta raise that price. And if the supply goes up and the demand is consistent, that price is gonna have to go down. We're gonna get more in depth into this in future episodes, but that's a good preliminary definition so you understand how supply and demand relate to one another and how it's used in the stock market. Because that leads us to our next definition, which is profit. A lot of people know what this means. Profit is just the difference between the amount of money you got back and the amount of money you put in. Now that could be positive and that could be negative. So, for example, if I put $1,000 into the stock market and I went home with 800, I have negative profit. I lost 200 bucks. If I put $1,000 into the stock market and I came back with 1,500, I have positive profit. I made about $500. That's what we're in it for. We're in it for the profit. And being that everybody wants this profit, it's the most sought after thing, positive profit, positive profit. There's other different types of mechanisms in order to make sure that we ensure that we get profit. And another one of those things is called leverage. Now, leverage is a much more in-depth concept to understand, but let's break it down and make it easier for you. So, let's talk about something totally unrelated to stocks. Let's talk about tools, right? And you may have a wrench, or you may have some type of crowbar or something like that, right? Now, everybody doesn't use this every day, but it's good to visualize this. So imagine you have a wrench in your hand, and you have a little tiny bolt that you have to loosen up. You're gonna take the wrench, and you're gonna put it on it, and you're gonna go to the edge of that wrench and push as hard as possible, right? Now, subconsciously, you're gonna do this because you know that's going to allow the most force to go to that wrench. Because if you went as close as possible to that wrench and you try to turn it over, it's a lot harder. Why? It's because you don't have as much leverage. The further the distance is out from that bolt, the more leverage you have. Now, what does that have to do with the stock market? Leverage in the stock market talks about other people's money. The more money you have, the more force you're able to make moves with. Now, how does that work? For example, if I have my own money and I'm willing to take a loan out against that money, I can use other people's money to make bigger moves. And we're gonna talk about that even more so in depth later on. But you can visualize how leverage can be involved into the stock market. So let's talk about shorts. A lot of people think that the only way you can make money in the stock market is when the price goes up. Because obviously that's natural to think like, yo, I bought it cheaply and I sell it higher, right? But no. A lot of people make money when the price goes down as well. What they do is they open up what's called a short sale. You're like, how does that work? I'm gonna explain it to you right now. What you do is you tell somebody, hey, listen, I see that you have, I don't know, Balenciagas, right? What I'm gonna do is I'm gonna take those Balenciagas off your hand, and I promise you, at a future date, I'm gonna give it back to you. So, what you do is you take those Balenciagas and you sell them immediately. Let's say they're going for $1,000 a pop. Now you have $1,000 in your hand, but you owe your boy those Balenciagas back, right? Now let's say the prices of those exact same pair of sneakers goes down to $100 for whatever reason. What you do, you buy the sneakers back and you give him the sneakers back. But you still have $900 worth of profit in your pocket. That's a short sale. You're expecting the price to go down, so you take the shares from somebody else, sell them immediately at market price, and then when the price goes down, you buy them back cheaper, give him back his units, and keep the difference. Next, I would like to talk about dividends. Everybody talks about dividends, and the definition is kind of in the term. Dividends sounds like divides, right? And that's essentially all that's happening. When companies make profit, they have to divide that profit amongst all the people who own that company. And you may not realize this, but when you own stock, you own that company. Literally. You are a part owner in that company. So when they have their profit and they allocate certain amounts of that profit to the ownership, you're getting a piece. You're getting that divided part for you, and they call that dividends. The more stock you own, the more dividends you get, but more or less, everybody gets the same rate per stock. Something else that's very important is to understand public versus private companies in an IPO. Now, this is very easy to understand, so just bear with me for a second. A public company is something that can be traded at a stock exchange, over the stock market, and just about any person with an American citizenship, sometimes even abroad, could come in and own parts in that company. Private, on the other hand, isn't as easily accessible. For example, if I start a company with my friend, that's probably going to be private for an extensive amount of time. And people won't be able to just buy stock in it from their bedroom. Whereas public companies, you just go on any type of trading app and buy directly into them. Now, what is an IPO? An IPO is when a private company starts to become public. They go through an extensive process by other banks and other entities to evaluate what the price per share is going to be, go to some other regulatory terms, and then they're gonna have their initial public offering. The first time they're allowing their shares to be sold publicly. That's what an IPO is. It stands for the initial public offering. And this is important because if you have a company that you've been looking at that you couldn't wait to get into, their first day of being publicly offered, you're able to get into it. You're able to ride that wave over a span of time. And then lastly, we're gonna talk a little bit about charts. Charts is just an easy way to show the history of the price and how it relates to time. Now, you can get more in-depth charts, but just look at it as a way to show the trend of what's been going on with the prices of the specific stock. Charts can be a little bit more daunting and it can seem kind of scary at first because you're not understanding what's going on with all these different lines and numbers. But as you start to understand each part in the use case of the chart, it becomes more and more and more readily available for you to be able to access them and understand what's actually going on, and then use that knowledge to make informed decisions about the future. I may do some more definitions next week because this is a very, very jam-packed area to talk about. But if you have any more questions and any more definitions that you want to hear about before we kind of get into the nitty-gritty, you know what you can do. DM me, message me, etc. And I'll make sure to answer those before we start talking a little bit more about use cases, and then obviously how you can get involved yourself, and then the final Q&A. So, we got into it today. Let me know if that was insightful. Hopefully it was, and I'll see you next time.